Welcome back to Fair Fate Investing. Today we're taking a look at Spotify as well as Apple, just to give you guys an update on a couple of companies and some things I'm noticing. So for Spotify, we've had a huge run up, about 300% in the last couple of years. Let's see if it's justified or what's going on. Even after that 300% run up, the company still operates at a loss, and they have a market cap of $61 billion. So seeing a $61 billion company operating at a loss is very surprising to me, and it's something that I don't necessarily feel comfortable seeing. If I were a shareholder, I would be a little bit questioning, can this continue? And to me, that looks unlikely. Taking a brief look at their stock today, I noticed this article, and so basically the summary of the article was that Spotify is launching a creative lab to test generative AI ads, and that could lead to some more profitability. But for now, it just seems like they're sort of betting on more expansion when I would rather see the company focus on increasing those margins or becoming profitable. For every dollar of debt, they have $2.65 of cash. Their gross margins are positive, but the rest of these margins look pretty bleak. Versus history, these are some of the better numbers they've achieved. Management looks like it's doing not very good at all. They have a very expensive forward price to earnings ratio. Again, they're currently unprofitable. Their annual revenues are up and to the right, so that's a great sign. But again, they're still unprofitable, and they're expanding into AI and things that they don't necessarily need to be doing. I think from a management standpoint, management is sort of focusing on the trend and trying to trigger people with the word AI as if it's going to get more investment. But I would much rather see the company just focus on those margins, do some better investing from a management standpoint, and not rely on those cash piles to stay above water. On a trailing 12-month, those revenues are pretty steady and up and to the right, but the margins are pretty shaky. And even when they were positive, their margins were very low. We can see lots of share sales, so reducing that shareholder value. And from a valuation standpoint with the DCF, it's just seriously overvalued, even with tremendous amounts of growth priced in. So for free cash flow, roughly 30%. Maybe they'll achieve it, but it just doesn't really leave much room for upside. I'd be very cautious at this point if I were a shareholder of Spotify Technology. It's had a huge run up. Great. If you made money on it, awesome. But the fundamentals and management raise a lot of questions for me. I don't like what they're doing right now. I would love to see the business focus on becoming profitable and protecting me from that downside risk in case there was some negative things happening in the future from a macroeconomic standpoint. But that's not what they're doing. They're sort of adopting this AI thing and I guess betting on that making them more profitable. That's my take on Spotify. I do not think it's going to have another 3 years like this. And I wouldn't be surprised if we saw something like that 2021 to 2022 happen again. But that's Spotify. So Apple had something like a 10% run up in the last couple days after their investor conference talking about their IntelliPhones. And what it seems like is it's a new cycle of phones where because they're going to integrate some AI software and features into their new devices, people's hardware is going to have to be upgraded to keep up with the software. And I've experienced this already. The computer that I'm using right now, I've done many things with AI, and my new investment strategy uses AI. And the things that I ask it to do will freeze the computer, and the hardware just cannot keep up with my requests and the AI compatibility. So it makes a lot of sense. This seems like a great move from Apple because they found a way finally to get people to upgrade their phones and their computers and their entire device line. I've had this computer for a very long time. I never had a reason to get a new one before. And now at this point, I'm starting to realize that even if you don't necessarily want AI on your computer in the way that Apple's integrating it, it's going to have the hardware to keep up with the future of software. We have a PE ratio of 33, a market cap of 3.26 trillion, and an enterprise value of 3.3 trillion. Cash debt ratio of 0.64, so for every dollar of debt they have 64 cents. Looking at the profitability, solid green bars versus the industry, versus history, again, the highest numbers they've had in the last 10 years, all except for free cash flow, which is still above that median, but very profitable business and very wide moat as well. This is about double their median price to earnings in the last 10 years, and still pretty far below that maximum. Revenues up and to the right, solid margins all throughout, and the trailing 12 months we can see revenues sort of slowing down, although those margins stay steady. And I wouldn't be surprised if this picked up a little bit and regained that growth. We can see lots of buybacks, so increasing shareholder value, and they just recently had that $100 billion buyback, so returning a lot of value to the shareholders. Looking at the DCF, there's currently about 21% growth for earnings per share over the next 10 years priced in. In the last 10, they've achieved 16, last 5, 19, and the last 3, 23. So if you think they're going to increase that growth, maybe even closer to that 3-year average, then we could see some upside. If you think they'll achieve 20, slight downside for a fair value. And if you think they hit that 16, 17, then it's clearly overvalued at this point. But that's just fair value. Stock prices can go a lot higher, a lot lower, and it all does depend on what they actually achieve for growth over the next 10 years. Looking at free cash flow, there's currently about 20.5 priced in for the next 10 years for free cash flow. In the last 10, they've achieved 14, last 5, 18.6, and the last 3, 14.6. So again, it depends if you think they can speed up that free cash flow with this new demand for new products and AI. I personally wouldn't bet against Apple in this situation because they have a very wide moat, and once you buy an Apple product, you're sort of locked in their ecosystem. Not to mention they're getting into banking. They've already gotten into streaming, and they compete with a company like Spotify. And they just have the money to throw hundreds of billions of dollars at stock repurchases and their AI bets, their hardware. So I think there's a lot of areas where Apple could actually keep expanding in the future. It may not expand as fast as some other companies that I'm looking at, but I definitely would not bet against Apple. But that's my take on these two stocks. If you enjoy these type of videos, make sure to leave a like. If you're not subscribed already, I don't know what you're waiting for. I post videos like this almost every week. And check out the bio if you're interested in learning a little bit more about investment or joining our Discord server.